All right, stock started a really important week off with a little bearishness, not very much of a move. You're not going to get very much of a move at all today, and you're going to have a relatively elevated VIX, but not necessarily, too elevated. Like we set the low point, so to speak. At least not until we get rid of the CPI report we have this week. So we still have that coming up. Consumer sentiment at the end of the week. We have bank earnings starting to come out. So earnings season is going to start kicking in gear. So there's a little bit of a calm before the storm. When you have really important weeks, Mondays tend to be pretty light, especially when you've had a big Friday. So Mondays, so that's the thing is we had a big Friday. We didn't lose any of it. We actually kind of held it and then added a little bit to the downside, especially in like the NASDAQ 100. So, we're not breaking down. We're still oversold. We're still kind of in convergence mode. I'm going to show you the patterns on the charts that kind of suggest, that we're not necessarily that bearish, and that we're looking for, at least I wouldn't expect a lot of bearishness, I guess would be the better way of saying that, since it has been pretty bearish to get to this point. It's we're so oversold. But because of that, we can expect some convergence, some slowing down of that decline, and eventually a little bit of a move. A little bit. I don't expect a big move to the upside, but a little bit of a move to the upside in the very short term, in my opinion, before we make that leg lower. So I'm going to show you why, show you all the charts that kind of support that. And the big moves today, despite the fact that bonds were off, trading was off, it was a very interesting pattern in the bond ETFs that were still traded on the equity exchanges that were open today, and what that suggests for the kind of market moves that we had heading into the inflation report. So let's go ahead and get started. Today is Monday, October the 10th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here in the bottom right corner of your screen, or the subscribe button down below. Hit the thumbs up icon down there to like our video. Comment on anything that stood out to you. Join our website at MarketScholars.com with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of our classes over here on the right, including our Market Outlook Live. Come down to the bottom, hit that heart, it opens up that tab, hit that like button. Same thing with this thumbs up icon, click that, it opens up this, click that like button as well. Again, I really appreciate it. We got to 105. This is like the third video in a row we've gotten over 100, so I really appreciate that. That goes a long way in helping get our content out to all of our followers on both of those platforms. So you can do it. Just click on those even right now while you're watching. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we came really close to another oversold cluster. We actually did get the oversold cluster in the NASDAQ 100. So NASDAQ 100 didn't quite get as many oversold clusters during this period, but it did today. An intermediate line down below 20. Of course, short-term sentiment lines down there too. Market sentiment's dropping below 50. The Russell's actually not as bad. The Russell's been outperforming here lately. It's not as close to those lows from last month. Short-term sentiment's bearish, but not extremely bearish, and then you have the intermediate line rolling over in bearish territory, but not down in the lower reversal zone. So obviously we are well below the moving average. The S&P is almost 6% below the moving average as we're approaching that September low point again, and again below the June low point already. So dark pink shading in a red line, not surprising to see that. You're going to get some light green shading, and when you're in the midst of a dark pink, of a bearish run, you're going to get some light pink shading or light green shadings throughout. Of course, is when it turns to dark green shading is when you start to look for a change in trend. But there's going to be plenty of light green shading, and there's going to be sometimes a light green shading in the yellow line. That's your bear tag. And we came close to it over here as well. So that's your bear tag pattern. Not quite getting that here. We got light green shading, but we didn't get close to the moving average. We're still well below these retracement lines that are acting as support levels, and back below the 23% retracement line, which means that we're still in this bearish leg lower to the downside. If we take a look at, you saw the NASDAQ 100, it did get the cluster. It's obviously well below. It did not get the light green shading during this little rally. The intermediate line rallied, but it was so oversold that it's actually still in the reversal zone. You have to get above 20 to get the light green shading, as you saw over here. So it's a little bit more bearish right now. The NASDAQ is down more than 7%. Of course, when you look at the Russell 2000, it's not as bearish. In fact, this intermediate line, or market sentiment line, just barely crossed below the midpoint of the chart. The orange dotted line you can see there. So it's actually got a better trade right now. It's still actually above its June lows. Remember, the S&P was below its June lows and was almost to its September lows. Russell's not nearly as close, and like I said, still above its June lows over there. In fact, the low of the year is still the June lows. Like even the September low point with all the clusters, 5 in a row, didn't produce a new year-to-date low point. So we're still above those. Of course, we are back below this 23% retracement line. We are back below this 50% retracement of the COVID rally, the post-COVID rally. Obviously well below those red and black lines that have been so important on the S&P. And you've got a really important 38% retracement of this big long-term move that we've already held for support twice. So we'll see if we end up breaking through that for a little bit more perspective on that. There's that red line again, goes all the way back to 2009. So you can see how important of a support it is. That's where the pre-COVID peaks were, a little bit above that, as well as the 2018 fall peaks. So getting above that line is really important breakdown on a long-term level, and obviously would more than likely coincide with more of a bear market in the broader market as well. Let's take a look at the weekly crossover chart. And you can see the PPO is falling in the lowest percent. In fact, this is the lowest PPO this week. We did get a higher close, but as of right now, we're closing below last week's body. So it nullifies the reversal, kind of similar to what we saw here. And we're seeing it again. So get the higher close, close above that, then you're fine. But closing back below this body, the lowest close, that's pretty much nullifies the higher low point. So we'll see how, it's only one day, so the week's not over with. But if we maintain this position or lower, especially, considering where we're at here, relatively speaking, with the falling PPO and the lowest, the biggest gap between the 10 and 40 week moving averages that we've seen, in this chart. In fact, it's bigger than even the gap we saw in COVID. See, the lowest it got there was minus 5.82, and right now you're at minus 6.19. So this is even more, a bigger gap between these two lines than what you saw right here before things turned around to the upside. We got the higher close, and then we reversed it. So that's what the long-term chart's telling us. Let's take a look at some of these oscillators. First, starting with the 3 green arrows first, we're back to 2 red arrows. So never did get the green arrow on the moving average. None of these did. So there's not any light pink shading, which would be 3 red arrows, but there's also not any green shading either, is what you need 3 green arrows to get. So we're nowhere near that level. And you can see it when you look at the 2 line versions of this. You can see we're easily back below the 17, even if the MACD itself is not below its moving average. So keep that in mind. That's why I'm not too, I'm not too gung-ho about the downside here, because the MACD is actually still above its moving average. Which is rising. So yeah, we're getting a little bit of weakness, but I wouldn't expect it to be a lot. I kind of compared for our Market Scholar students this move going into October expiration, similar to this one, where you had such a deep drop, kind of a washout move there going into June expiration. Then we just kind of went up and down sideways for a full expiration cycle as we let these lines converge and the orange line rally. Then it had to choose, right? We could have turned back down below the moving average and just made a new leg lower, or break above the 0 and break above the 17 and get going. And it did the latter in that case. I don't think the latter's coming. I think we'll probably make one more leg lower this go around to the downside towards that 3200 area. But you can see the kind of setup there. So I wouldn't get too crazy about this bearishness. I think there's still some upside back up towards 3,800. in that area where those Fibonacci resistance levels are, as we meander through this expiration, this options expiration coming up next week. All right, let's take a look at some of these other oscillators. Looking at the directional movement index, of course, the negative indicator is still back above 30, which, the positive is below 20. So we came close to turning things around, but we didn't. But we are setting up potentially for some divergences there. As of right now, those are pretty bearish patterns as we speak. Looking at the Ichimoku cloud, you can see we are well below the cloud. The price is well below where it was 26 days ago. We have a mature bearish trend with the trend quality and noise balance, so things are remaining bearish there. When you look at its RSI and the CCI, you are at the low end of the kind of neutral range. It's not really too bearish. You're a little bit below 40 there, but you can see the CCI is not really in bearish range at all. I wanted to show you the stochastics as well. You can see how we're back below that 10th percentile. The orange line is still below 20. It's so rare for the orange line to be below 20. And not only are we below it, but we're kind of staying below it, which is pretty significant there. I also wanted to show you the hull. We look at the hull sometimes here. You can see the two bearish candles we got Friday and then today with the lower close and the parabolic SAR shifting to the upside. We're not, we don't have the red candle yet, but assuming we hold this tomorrow, get a lower close in the Hakunashi, then you'll probably get the red line on the whole moving average as well. Again, kind of, significant in terms of showing the trend change to the downside there. I also want to look at the Bollinger Bands. You can see we had gotten up to the midpoint of the Bollinger Band width. We are now back into the lowest quartile of the lower bandwidth. Now we're not necessarily breaking out. The bandwidth is still falling. That's why I still think, kind of like what we saw here in June's July expiration, that really high bandwidth was falling. We just stayed sideways for a while, and I see that developing here as well until we get a low bandwidth, and you can either break out either to the upside or a continuation move to the downside. Considering that we're below the value area, my guess would be that we'll get more of a continuation move to the downside, though. In the midst of the consolidation, you're going to get some pretty good swings both up and down to the point where people are going to expect it to be the bottom, right? All right, let's take a look at the intraday chart. You can see we did get a lower high and a lower low. We did close below the low slightly. It's not very much. We're actually up today in the after hours. You can see up there in the top left, up at 360, almost 361. So I wouldn't say we closed below the yesterday's low, and obviously we did not close below last week's low point. Now we're sitting right on them, but we're not closing below them yet. So keep in mind, if we get through to start to fill in this gap here, we're probably going to make a run towards a little bit more of a sustained run towards 380 than the one that we got early last week. Finally, let's take a look at the VIX. The VIX jumped up to a 32. Again, it's so rare for the VIX to be above 30 and for the VIX ratio to not even be above 100%, much less, it's actually typically closer to 125 or more when the VIX is above 30. So it's very rare. And also, too, what you're seeing is the VVIX. Again, when the VIX is at 30, the VVIX tends to be pretty high too, and it's just not. It's at 107, so it's relatively low compared to where we've been for most of this year and then last year, even though we are coming off a low. But again, with the VIX at 30, that usually pushes the VVIX up to some pretty high levels. So it kind of gives you an idea what kind of market we're here. The market is kind of got skittish, and they're kind of waiting for some shoes to drop before the bearish train leaves the station and starts making its way up towards the typical 6 month to up to 18 months time frame for those bear markets to evolve and ultimately hit their low point. All right, now let's take a look at what's driving price action. And you've got two of the main themes for the year. The dollar was strong again, up more than 1/3%. Long-term bonds were down. Now, granted, it was Columbus Day, so the bond market wasn't open, but this is the ETF that tracks bond yields. So the idea is that bond yields would have been up pretty considerably had the bond market been open today. So TLT is down more than 1.5%. Gold's down, so that's not really your most risk-on appetite. Those are your two, outside the dollar, the two biggest safe haven areas there are, and they ended up down the most. Kind of gives you an idea of what kind of market we may be in right now. Of course, the dollar continues its run to the upside, back above its 8-day moving average very simply. Commodities are kind of get a little bit of an engulfing pattern here at that 23% retracement level, so it's trying to figure out if it wants to get going or not. It hasn't quite decided whether it wants to keep this trend and break through some important resistance. Of course, crude oil came down to that 78% retracement and bounced at the bottom of its 1-year value area. Got back through the 30 and the 50. The 8 and 17 day have crossed above the 30. That's a pretty good sign for a potential bullish pattern there. So keep your eyes out on how commodities doing. Of course, gold's the other asset class that dropped pretty sharply, and just like bonds, it's kind of rolled over. So again, not your typical safe haven trade when you can see two of your bigger safe haven asset classes dropping pretty considerably on this day. You can see Bitcoin, kind of the opposite end of the spectrum, back below 19,000. And again, like I said, getting below that 18,150, that kind of gives you an idea of what could happen. Like it's a really, really important level. If you look at it on this weekly chart, you break this level and you're looking at 10,000 essentially or less before you find something that might break your fall on Bitcoin. So far cry from the 69,000 it peaked at late last year. Let's take a look at how the sectors are doing. So give me 1 second to pull up the comparison for the sectors. Okay, so you can see we had our safety trades, utilities and staples outpacing most everybody else today. You also have materials and industrials, which are kind of economic growth sensitive areas. On the flip side, energy, which had been a big winner, down. Technology, which has been a big winner for most of the years, down. Real estate's continuing to be down. So you can see what had been really working is just not working anymore. We are definitely in a regime change where, like Apple, for example, had this big run up here from mid-June to mid-August, and it's pretty much erased all that move to the upside. It's now starting its own correction down to its 200-week moving average. Of course, getting down to it and through it would be quite the significant, getting down below $100 would be significant for a stock that was trading at $183 at the beginning of the year. All right, let's take a look at our trade I did today. I'm going to take a look at Walmart. Oops, how did I actually get that symbol typed in? There we go. You can see the intermediate lines down, and you got the dark pink shading, but you're not that bearish. Market sentiment line looks like it may be peaking. You're not that far below the 30-day moving average there. And when you look at some of these other charts, its weekly chart here, you started to get a potential reversal here last week, very similar to the markets, but you closed, as of right now, only 1 day into this week, we're closing below those two bodies, so it's pretty bearish from that perspective. 3 green arrow wise, we have 3 red arrows again on Walmart, so pink shading. You can see what that looks like. On the 2-line version of this chart, you can see that you're below the moving averages. We're still inside the value area. We haven't broken below the value area, but we are. The 8 and 17 are crossed below the 30. They're below the 50. The 30 is about to cross the 50. So you definitely had some little bearish headwind. Of course, the bandwidth is really, really low on the stock. You can see the bandwidth is down. It's actually dropping at really low levels. You're in the lowest quartile. You're in the value area, as I said. You're not breaking through. Right now you'd be looking for a breakout one way or the other. We're not getting that. When you look at the Keltner channels, along with the Bollinger Bands, the bands are easily inside the Keltner channel. So you're kind of waiting for a breakout move to get this stock going one way or the other. I think I might have already shown you this. We're above 25 on the negative, well below 20 looking at some of these other oscillators, the RSI and the CCI. Now you can see kind of a neutral range for both of them, low end of the neutral range, but neutral, pretty much neutral for the most part. You can look at, it's still barely below the cloud there, but both of the green and blue lines are still inside the cloud. And the red line, you can see, we are down, rate of change over the 26 days is negative. And you actually have a weak bearish trend developing after being in a very noisy period for quite a while there. So relatively bearish, but not as bearish as we think. So what I decided to do was just do an iron condor spread, selling the low 20s on the delta, buying one strike away, selling the low 20s on the delta, buying one strike away. That sets up that trade that you see there. Maybe with this one, pretty decent normal position sizing, pretty decent reward for that risk. If I set slices to break even and put them onto the chart, you can see this thing would have to get above this previous highs in August, get through the value area. It'd really be trending to the upside if it did that. On the downside, it would have to get through the 52-week lows and break down pretty hard. You can see the likelihood of neither one of those scenarios is going to be relatively small. So that's why it's good to take advantage of that and again do the iron condor spread and see what we can ultimately get at a relatively high probability scenario for getting a reward. We'll see how much we ultimately get to keep out of that, $474. That is the maximum gain for the trade. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. And then follow and like us on Twitter and Facebook. Have a great rest of your Monday night, everybody. And we'll see you in class next time.